Audio isn't going to be booming in through here. We are live.
Yeah, you don't sound excited about
it. All right, cool. Now I'm excited. Y'all ready? Let's go. Let's give the people what they want. Welcome to the weekly Not Your Average Investor Show. Today, we are talking about something everybody wants to talk about. When we are talking about folks that want to invest in rental properties, many of us are trying to figure out how to find more capital, how to increase cash flow, how to speed up this speed to retirement. And today, we're talking about exactly that, creative ways to fund more rentals, increase your cash flow, grow your portfolio. I'm your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and his name also happens to be Greg Cohen. Say hello, GC.
Hello, everybody. Fantastic to be with you today.
And the star of the show today, we are bringing her, we're bringing her team back. This is the first time we have her. She is the author of Creating Your Income Snowball, the passive investing cheat code for mastering wealth, and the president and CEO of Tardis Wealth Strategy. Joining us at 6:30 in the morning from Hawaii, Tanisha Souza. Welcome to the show.
Great to be here. I'm excited.
Yeah, thanks for waking up. When she joined us, she was like, "Well, it's dark outside for me."
So. Yep. Hard to get Tanisha anywhere, but definitely the 12:30 Eastern time zone is a challenge. But we are so happy to have you, Tanisha.
Happy to have you, Tanisha. And we have a little tradition that we like to start the show off that we warned you a little bit about. You see, what's that called?
The roll call, baby.
Oh, we got Jaime Pedraza kicking us off. Jimmy Jamis from New York.
All right, love that.
Good to have you. We got the MVPs in the house.
Mr. Lee Bishop.
We got the patron Santorios of Northern Virginia.
Michael Santorios.
Laura Colby from Washington State.
Good morning, Laura.
Good morning, Laura. We got Il Maestro.
John Williams.
John Williams.
You know, John Williams is coming to the Symphony here in Jacksonville. I saw the tickets yesterday. I immediately thought of John Williams.
So coming from Long Island, New York to the Symphony. We got the Shawman.
Nadeem Shah.
Nadeem Shah from the Pacific Northwest with his trademark. Good morning, good afternoon. We got the KOB, King of the Beach.
Christopher Lee.
Christopher Lee from Fernandina Beach. Christopher, good to have you back. We got
Billy Green.
Good to have you, Billy. We got our regulars, Gary and Rosalind Riley from Marietta, California.
We regard you.
Who else we got in here? We got the fairy godmother of the Not Your Average Investor.
Miss Jen Filzen.
Jen Filzen, who I believe is a Tardis client after our first call.
Oh, that's right.
Yeah, that's right. We got Max Needle in the house.
All right, Max, what's up, buddy?
Good to have you. Who we got? Oh, my buddy, Bob Wiesner from Atlanta.
There we go, Bob.
Silvana Kuchar from New Jersey.
New name?
All right. Welcome to the show, Silvana.
Welcome to the party.
Hope you make yourself comfortable. Our friend from South Carolina, Linda Mercurio.
Linda, how are you?
Staying dry from the hurricane. Linda, congratulations on that one hurricane pushing the other hurricane away.
There we go.
HTTN is back. Good to have you, HT. Who else we got in here? All right, cool. Good roll call today. Still going. I want to get straight into this topic because I think this one's going to be meaty.
Mm-hmm.
We had this joint webinar not that long. I forget how long ago we had with Tardis team.
End of May.
And I know that our community really got a ton of value out of it. I know a bunch of folks went over to Tardis. If, as you're listening to this stuff, you want to book a free consultation with Tardis, I suggest you just scan this QR code right now, get it on the books. It's a free consultation. You'll get to dive more into this with Tanisha and her team. If you want to talk to JWB, go to chatwithjwb.com. That being said, the reason why folks booked that call, Tanisha, is because the first one was all about this income snowball that you were just telling us you're the inventor of, right? Like you commissioned some Harvard, you had this idea, people told you it wasn't going to work. You commissioned some Harvard mathematicians and you figured it out. Tell us a little bit about this income snowball and how it works, Tanisha.
Well, the income snowball was, it was kind of a marriage of a bunch of different ideas. At first, when we first started our business, we were a mortgage acceleration company, teaching people how to pay up their mortgages faster. And I was like, well, we don't even have a mortgage. At that time, we only owned rental real estate. So we were renting our home from my father-in-law, and we purchased a strip mall. And that was enough to basically make us retire. We were financially free from that one property. We had flipped some properties and done some things before that. So we believe in real estate. Real estate was how we became financially free. It was awesome. That made it risk-free for us to start our business. And so when we started that, I had an opportunity to quit my job. I was a lawyer. Don't hold that against me. but I didn't like it. So I was like, oh, this is an opportunity for me to quit and I can start this business I know nothing about. So started the business, and I was looking at, Chris and I were investing and we were looking at different opportunities in different ways. And I came up with a way to basically use a certain type of investment, what we call fast burning fuel, to accelerate retirement and to do it a lot faster. We did it, I think, in a little bit of risky way. I wouldn't recommend the average person go out and start flipping homes. Especially, you got to leave it to the experts to do that. And we made a lot of mistakes, and I'm shocked that we didn't like lose everything trying to do that. But we were able to get into that strip mall, and the cash flow was more than what I needed to retire. So work was optional at that point. So we started the business with no risk, and we did that. So the idea came to me when I was doing this, because looking at different properties, and I thought, well, what if I were to buy these other investments and create more cash flow? How many more properties would I be able to buy, and things like that? I was running all these different numbers, and I got these guys involved who were clients of mine in the Mortgage Acceleration Company. And I said, hey, I have this other idea that would involve purely investing, not paying off debts, not doing any of that, purely investing. Take a look at this. What do you think? And they were like, it was actually a woman. I think she was in her late 20s, early 30s, and her dad was a professor at Harvard. So she was a Harvard mathematician. Her dad was also a professor. They both looked at it and they were like, this is a great idea, needs a little tweaking. So they tweaked it and helped me formulate it. And then I was able to get a patent on it in 2014. So we've been doing this for a while. We've actually started it, I think it was maybe 4 or 5 years before, 5 years before we got the patent. And then we were able to get the patent on the calculator that does the whole math behind it. But it generally allows people to reach financial freedom in 5 to 10 years, as opposed to the Wall Street 30 to 40 years. So, so people, a lot of our people are like your people, right? They understand cash flow, they get the growth model, that's kind of the foundation of what it is that we do. So, we're in alignment here. And so when people see it, they're like, oh my gosh, I want to build this huge portfolio of rental properties. I want to do these other things with, how can I do it faster, right? And I don't have to just use my own cash flow. Well, this is the way, right? TARDIS is the way. So
I love it. As before the show, Greg was like, there's something really, really unique about this system, right? Like I think you were differentiating between what most people think that is essentially interest rate arbitrage and what is foundational to this like income snowball. You want to kind of explain that, GC?
Yeah, absolutely. And Tanisha, we were chatting about how excited we are to bring you onto our platform here. As the community knows, we don't really bring a lot of guests on, but when I do my own research and I learn about a company, not just from their core values, but really kind of dig into the numbers, and I see something that's really going to help our community here, we want to share that. And my experience of TARDIS is I probably was the longest sale that your team has ever probably had to have, because I had them going through 3, 4, 5, 6 hours of the numbers with me. And as I did that, and I brought my team in and we started to learn more about this, I said, man, this is something unique. So to get back to kind of what we were talking about, there's kind of like interest rate arbitrage, and then there's cash flow arbitrage. And Tanisha, would you mind kind of sharing the difference? Because I think this is such a critical, very cool aha moment for our community.
Yeah, so I think one of the things, so there's a lot of nuances, and I'm so glad you shared that, it took you a while to kind of wrap your head around it, because sometimes people look at it and they go, well, that's so simple, but it's actually a lot deeper than that. But I'll get into that probably as we go, but I'll just talk about the arbitrage for a minute. So one of the things people mistake, especially because everyone's pretty traditionally minded, is interest rates, right? They're always stuck on interest rates, and they're like, oh, this interest rates, oh, interest rates too high, I can't buy real estate right now, or interest rate, I got to do this and that. The thing about interest rates is, they're important to a certain degree, but what we're doing is we're actually arbitraging cash flow, which is much more important than trying to arbitrage interest rates. So if you're taking, say, a line of credit, an interest-only line of credit, right? The amount that you're paying on that is based on the amount that you owe. And that'll fluctuate depending on if you owe very little or a lot. And so that cash flow is, I mean, this is part of the reason why I'm sure you guys know about these all-in-one, right? The reason why people get those all-in-one loans, right? Because they're interest only. Or if you get a home equity line on your home or whatever to do whatever you're trying to do, that's typically, not always, but typically interest only. Now, if you're able to get from an investment principal and interest back, and it's short term, so you're getting huge amounts of cash flow, right? The shorter the term, the larger the payment. Now what you're doing is you're trading, right? You're trading a little bit of money out for a lot of money back in. A little bit of money out, lot back in. So the little bit of money out is the amount you're paying on that, the incremental leverage that we use. And the amount that you're getting back is astronomical compared to the amount that you're putting out, right? Using other people's money. And your audience knows all about that. If you're a real estate investor, you understand that about other people's money. But it's really 3 steps, right? It's 3 steps. The first one is we look for additional cash flow. We help people find the extra cash flow. People are like, oh, I only have like $500 a month or $1,500 a month or $2,000. We usually help them find an extra $600. That's average, right? Not everyone, but on average about $600. So the first thing we do is help them find that extra cash. The second thing we do is we deploy that into these fast burning fuel assets, these income producing assets that pay you principal and interest over a short period of time. And, if you think of it if you make an analogy to a mortgage, no one in their right mind, when they buy rental properties, are going to get a 15-year mortgage, right? And the reason for that is it's going to put them in a serious negative cash flow, right? So they're always going to, or they should, try to get a 30-year mortgage so that they can maximize the cash flow. Now, when you're the investor using Income Snowball and you're doing a cash flow arbitrage, you want to be on the other side of that. You want to be the bank. You want to be the one that's collecting most of that cash flow. So you want it as short as possible, right? Because you're going to get a huge fat check every month, or, huge amount that you're going to get. So if you can use small incremental amounts of leverage to purchase these assets, right? We're actually using the cash flow that you put in, and then also little small incremental amounts of leverage to give you more buying power. So you're able to buy more of these assets, fast burning fuels that we call it. That income is huge for the amount that you're putting out, and that's really the key. And that's part of, I think, one of the things that makes it really unique. I mean, that's just one element. So that second part, like I said, is deploying that into these assets. And then the third part is using that incremental leverage, a small incremental leverage to give you more buying power to buy more faster, and then start stacking those investments. So those are the 3 parts to the Income Snowball system there.
It's a pretty incredible system, and Tanisha, we have a lot of self-proclaimed data nerds in the group here. I'm the biggest one of the bunch probably, and so for all of my data nerds out there, what we're talking about is really talking about creating an income stream out of nothing, and the way that we do that is through the TARDIS system, is through a cash flow arbitrage. We're talking about creating a line of credit, which Tanisha's team helps you do, and then that line of credit is used. You pay it on an interest-only basis. And Tanisha, tell me if I'm wrong here, but I'm trying to make sure I understand it for the audience too. Tanisha's team helps you get that line of credit. You pay interest only on that line of credit. And what Tanisha's team also helps you do is to find another investment that pays you not just interest only, but also principal. And there's a whole lot more to it than that. But for all of our folks here on the show, Pablo, how many times have we heard, hey, listen, Greg, Pablo, not your average investors, we love rental property investing. The only reason I'm not doing it is because why?
I don't have the money.
Because I don't have the money. And what's my answer, Pablo?
The money is the easiest part to solve.
The money is the easiest part of the problem to solve, as long as you surround yourself with the right team and the right expertise. Well, what Tanisha is sharing with you here is this is a way to create money from this type of arbitrage that allows you to buy your first rental property, or allows you to build up cash reserves, or allows you to invest in any other number of assets. Tanisha, how did I do with kind of explaining that for the audience?
Pretty good. I think that's pretty good. One thing I'd want them to know too is I'm going to give you an example. I'm going to give you a story. There's a couple. Their name is Chris and Sharon, and they were in their 40s, early 40s, and they had a business. They were looking to buy. They had one rental property, just one, and they wanted to buy more. It was free and clear, and they had their home was paid off. So they were kind of like those people that were like, "Ah, I just want to be debt free." But that doesn't get you financially free, right? You can be debt free and still have bills to pay. So they were like, well, we want to shut this business down. They came to Tardis. We gave them, I think it was like a 4.5, 5 year plan. They were able to, in 2 years, create $44,000 in monthly income through the income snowball, through fast burning fuel, and 13 rental properties that they were able to purchase. Okay. 2.5 years. Okay.
That's
Two and a
great.
half years.
Yeah. That's
That's like one of the fastest, I'm telling you. I mean, individual results vary, but come on. You know what I'm saying? To go from that, like, okay, to 13 rental properties that cash flow way more than the one that they had.
yeah.
I mean, that's
Yeah.
crazy.
I think there's so many folks in our community that want to get to 10 rental properties, right? Like,
Mhm.
and even more foundationally, what you just talked about, Tanisha, right? Like, for me, I love the idea of getting 10 rental properties and, having 10K a month in passive income, whatever. The what I value the most is agency, right? Like what you had described as kind of like how you started this business that you started now because you were able to, because you
Yeah.
had, like you created this floor of income that you can now then go experiment and tinker and like follow your passions and find your way into the world. Like that to me is like the most attractive piece of it. Yes, many of us are going to put it into rental properties, but like, I think foundationally the high floor of creating this income system is really attractive to me. And I'm not the expert on this call, right? Like I call myself the noble fool of the show. What I'm missing here, I can understand conceptually. I'm borrowing this money at a certain rate, putting it in something that pays me back principal and interest at a certain rate that's greater than that. This part is all profit. I stack them up, like, and I have like this much. My biggest question would be what do these, because for the sake of our audience, right, we're going to go into like what these assets look like, and then we're going to talk about, if you're thinking about this for yourself, how to like mitigate the risk, because that sounds really scary to like increase the debt and stuff like that. So like, how do you know you're doing it? But my biggest question is like, what does this fast burning fuel that you call, what do these assets look like? I like, what are these? What are examples of these kinds of like investments that do this?
Okay, so there's quite a few just floating around out there. I'll name one. So prosper.com, right? So that one's been around for a long time, and it's basically peer-to-peer lending where they'll pay you principal and interest over 2 years, 3 years, 5 years, depending on what it is. And what's nice about it is you're able to diversify amongst, you're not like loaning one person 10 grand or 5,000 or something ridiculous like that. You're giving every person maybe $25 across 1,000 different people. So that's pretty well diversified. And you're able to, I mean, there's things too that you need to watch out for when you do that to make sure that, you're mitigating risk, but we'll talk about that later. But the key is that's one type of investment. There's actually a few others like ground floor. And then we have several companies actually now, three or four, that have built products around the income snowball. So what they've done is they've created fast burning fuel based using their other types of investments. So some of these are funds that contain, investments like senior loan debt, things like that. So you're basically the lender, and it's a fund, and you get paid principal and interest back every single month. But these companies, right? They know we've been around for a long time. They know our reputation. So they're like, hey, we want to help your clients. We know they need this fast burning fuel to be able to do all these things that they want to do, whether it's retire, whether it's buy real estate, whatever. And really just even enhance their lifestyle today, because I think one of the big things that we hear all the time is this like a 401k where I've got to it's going to suck my cash flow out every month, and I'm not going to be able to go on vacations, and I'm not going to be able to do anything else. No, you can use some of that money now and in the future, which is very different from your traditional retirement account type of thing. Similar to real estate, just regular, if you were just going to buy one property, you could use some of that cash flow right now as you're building your real estate portfolio. So anyway, but the idea is these different types of investments, they're growing, right? We're getting contacted all the time by these major companies that are like, hey, we want to create a product. Let's talk. And so there's just several of them out there that have created products specifically for our clients that are fast burning fuel in nature. But real estate is what we call slow burning fuel, right? And they actually have a yin yang relationship. So you can use the fast burning fuel, and that will create a huge amount of cash flow fast. And then what you do is you use that cash flow, right, that you're creating, which is usually thousands of dollars very quickly per month. You see cash flow in the first 45 days, but you get to those thousands, a year, 2 years, whatever. For like the couple I told you about, like I said, it was 2.5 years, $44,000. That included all of their rental properties and the fast burning fuel. The thing about it, and this is part of how they did it so fast, when you do have rental properties, when you add that slow burning fuel to the fast burning by itself can get you to financial freedom typically in about 5 to 10 years. Slow burning, you add that. So let's say your financial freedom date, we run your numbers on the calculator. Your financial freedom date's 8 years. You get one property that cash flows just a little bit, like $200 a month. That one can actually speed up your financial freedom date by 1 to 2 years because the slow burning fuel produces potentially lifetime income, right? So you're taking the fast burning fuel, which is maybe 2 years, 3 years, and you're stacking those investments. And then you add in this one permanent source that doesn't even have to be close to the cash flow that you're creating over here. And it can literally do wonders for your financial freedom date. Now imagine if you have 3 or 4 or 5 of those, how fast it can speed it up. So now you know how they were able to do it. So I always hesitate to tell people when I say things like, oh, these guys did it, $44,000 in 2.5 years, because everyone's situation is different. They owned a lot of rentals and they had a lot of fast burning fuel. And they weren't even serious in the beginning. They were slow walking it, I mean, they were like, is this real? Let me just dip my toe in. I think I'm going to put a little bit of cash flow in. And then when they saw it, I think maybe it was 6 to 8 months in, they were like, oh gosh, let's just do this. Let's not like dilly dally and, put $800 in or whatever. They had a lot more cash flow than that they could deploy to put into their snowball, but they didn't do it for, 6 to 8 months before they really got into it. So,
I do a class and I call it the myth of the mega portfolio. And it's like, as educators, I think we try to spend a lot of time teaching people about this beautiful asset class. And there's 5 different ways that rental properties pay you. And so we spend some time getting there. But then once people get there, what I find is people believe in single family rental properties. Then somehow in their head, they say to themselves, well, I need to have 50 in order to retire, or I need to have 20 in order to make a change in my life. And it's really not the case. And I love how you all break down their target date of their financial outcome. And you can see just by adding one rental property with the right team, it might speed it up by a year, right? 2, 3. It's this asset class that for some reason, people just don't understand right off the bat. And as soon as they do, they almost convince themselves that it's not enough. But what we're able to see is that it is. So that's why this, but as a rental property provider like we are, the one thing that I can't do within JWB is I don't have a product available for you to go from 0 to the down payment required for your first rental property, right? And that's why working together with a company like Targus solves that problem. But then it's not just there, it's, well, once we get there, how do we take you from 1 property to 3 or 5 or whatever that goal that you have dictates? And it's the same type of accumulation. It can be the fast burning fuel, which is more of that kind of cash flow accumulation in the short run, but then you can convert that over to your slow burning fuel, which is You know, I've never heard rental properties called slow burning fuel before, but I like
Makes
it.
sense.
That's kind of, you know, that's I can dig that, right?
Yeah.
And that's why a product like this, you know, can work so well. And I think even more than that, I want to expose everybody in our audience to different ways of thinking that might expand your mind. And for all of you who are saying, I love this asset class, I want to build my financial outcome based on it, but I don't have the money to get started. Well, this show is really dedicated to you.
hmm
And
And
there's
not
a
only that too. I mean, let me add something to what you just said. Those who are just wanting to get started and they're like, I don't have the cash, or they already have three or four and they're just tapped out, right? They're like, okay, I'm tapped out, my cash flow's gone. How do I get to the next three or four, right? And so this is a way that they can do that a lot faster, a lot easier. So anyway.
I love that. And I want to add one more on there. One real life example is sometimes they're at 3 or 4 or 6 or 10 or whatever the number is. But you know what? They don't have enough reserves built up.
Mm.
And the way that you win in this game is you work with the right team, buy in the right market, buy the right asset, and you hold. And you need to hold on for a full market cycle. And where a system like this can really come in handy is when we think about using that cash to do whatever the best need is. And sometimes the best need is building up those cash reserves so that you stay in the game long enough to be able to be paid by those 5 profit centers.
100%. I would
Yeah.
1000% agree with that.
As rental property owners, the
Yes.
three of us,
Yeah.
we know that.
Yeah. I was just gonna say, money doesn't buy happiness, but it certainly helps you focus on better problems. Like so having cash reserves is great. And there's something really awesome happening in the chat right now. Rob Joseph, Jen Filzen, they're, like Rob is an old client of yours, has been with you for a while, and is curious about JWB. Jen is like the godmother of our community, giving out her cell phone number for folks that want to hear about her experience with TARDIS because she just signed up. And John Williams, also Il Maestro, is also a new client with y'all as well, giving you a lot of love and saying that this is a good experience. And this is, like one of these kind of like, this is the value of community that we were just talking about, right? Like access to folks that have been there, and you can come, look, touch, see it, share personal experiences. I want to welcome everybody. If you want to talk to JWB, go to chat with JWB. If you want to talk to TARDIS, scan this QR code. If you want the JWB quarterly market update outlook for Q4 2025, what year are we in? 2025 here in Jacksonville that we just published. You can get that here at jwbrealestatecapital.com/report. And again, the complimentary strategy session with TARDIS, as we are talking about this stuff, right? I think the reason why people like to reach out to Jen and reach out to Rob and reach out to Il Maestro is because we hear this stuff and it sounds like mathematically it makes sense, right? Like I think rationally it makes sense. And yet the number one place that I go to is like, God, what if this is too good to be true? And more importantly, like, how can I really trust myself with this stuff, right? Like, how can I hedge for risk here? How can I just not fall in love with anything? So, Tanisha, I wonder, as you're doing these complex mathematical equations and picking assets to invest in, how do you evaluate the risk on these? First of all, I love the fast burning, slow burning fuel thing. I'm a total, like, I think language creates like a new thing in the mind and a new way of thinking, right? But like when you're thinking about this like fast burning fuel, how do you know it's not too risky, and you're not just kind of like over leveraging yourself in something that sounds too good to be true?
Yeah, I love that. I love that question. Yeah, because the thing is, I think it's important for people to understand it's not about a strategy, right? You don't want to just, move forward on a strategy. You have to have you have to have the whole thing laid out. So I'll give you like kind of walk you through what we do. So beyond those first three steps that I talked about, that's the help you find more cash flow, then deploy that cash flow into income producing assets and use the incremental leverage to give you more buying power to buy more faster, stack those investments. That's, the essence there. But the risk really is in, buying the wrong investments, not knowing your risk tolerance, getting something, I would really caution people. And this is why I don't even teach my clients this. I only teach a small segment of my clients about how to buy commercial real estate, because before you do that, you really need to get your hands dirty on single family homes. I mean, there's so much more that you have to know. So the first thing we do is look at risk tolerance, right? So we have a risk assessment, everyone takes it, it's for them. They're able to see, okay, I'm kind of moderately conservative or I'm very aggressive. We look at the age, all that kind of stuff. And then the coach that works with you is able to help you kind of figure out, okay, these are the types of investments that fit your risk tolerance. You shouldn't be looking at these things. So when your crazy Uncle Larry comes in with some, the best thing since sliced bread or this great investment opportunity they heard about, you're not going to go chase the next shiny object, right? You're going to stay within your lane. The other thing is looking at criteria. So, okay, we're talking about real estate. So let's say that you want to buy a rental property. Most people don't know what their criteria are. They're just like, hey, just find me something, right? It's like, okay, what if you, before you invested in anything, what if you knew before you invested if that investment not only fit your risk tolerance, but also fit your criteria and would actually enhance your, financial freedom date, or you want to buy whatever you're trying to do, if you knew that it would work first, it would be amazing before you even bought it. So those are the kinds of things that we're able to do. Look at your risk tolerance, your criteria, due diligence, right? We can show you how to conduct due diligence on any type of investment. And we actually have some AI tools that we help you build for yourself so that you can do this so much faster. And so some of it, especially with commercial, which is what I deal in mostly for myself now, I have these AI tools that I built that it used to take weeks to do due diligence on on a multifamily or on a strip mall or whatever. And now it takes me like minutes. It's so crazy. If I have the documents, I can do it quickly. I can go deeper than I was able to go before, all of that. So we help you with all of that as well. So risk tolerance, criteria, due diligence, and then contingency plans, because people, especially when they're new to investing or fairly new, they tend to be very optimistic and think nothing could ever go wrong. This is why you need to have the reserves that we talked about. And that's the reason why you need to have a plan A, B, and C if something goes wrong with whatever the investment is, whether it's Prosper, whether it's a rental property, doesn't matter what it is. You want to have your contingency plan laid out before you invest. Now imagine that. You have that set up. Then what happens is if anything happens, oh, okay, my renter, did this, or the rent is late for 2 or 3 months, what do I do? Right? You already know what to do. It's nothing major, not losing sleep. You basically just click the button and you're good to go. So it just makes it so much better. You're not sitting up there, mad at the property manager, upset at everything around you, thinking the world is against you. It just happens. It's like it happens. So just be prepared. And once you have all that down, you really become an expert. And that's really what we're trying to help our clients do is become an expert. So back to your original question, which was how do you mitigate the risk? That's the main thing that we do. So even people, when they come in with their existing investments, they're like, look at I have a 401k. I don't really know how it's doing. We'll help them take a look at that and say, okay, or their IRA will say, okay, maybe you can do this, or have you tried doing this or shifting this around? And now their existing investments make more money than they were before, because now they have a coach and someone who understands what it is that they're doing, helping them make sense of it all, and then maybe making some adjustments so that they can do something that's going to create more income and cash flow on the short term and the long run as well. Yeah.
I like the framework of doing a risk assessment, creating your own criteria, doing due diligence, creating contingency plans, right? It's almost like the how we talk about, right? Like cash flow is the entrance to the dance for rental properties, because as long as you are cash flow positive, you are creating a scenario where you have like a certain level of risk mitigation and for experience, but then creating these like contingencies and what you're going to do next. It reminds me a lot of like how you talk about reserves, right? You want to kind of like talk about like your ideas on The reason people like leave the asset class is because they see this as a different way than other assets versus having these contingency plans.
Yeah, and I see so many similarities when we're talking about fast burning
Yeah.
fuel, slow burning fuel, rental property investing, the TARDIS approach, the JWB approach. It's all based on, sound. There's a financial education, there's a financial reason that this is going to work, but it's surrounding yourself with the right team and then following through on the plan. And so when we think about rental property investing, it is about the most it is the most consistent, reliable asset class. It has above average growth. It has all of these things, and you simply buy and you hold and you get there. And that's really, really what it is. That's why, if you think about it, why do banks love to lend on real estate? It's because it's consistent, it's reliable. I can guarantee you that there wouldn't be an entire banking system built on lending on real estate if it wasn't consistent, reliable, if there weren't profits to be had. So it's like you just gotta find the right team,
Yeah.
find a system, and then hold. So now one reason why people don't do that? Well, they might not do their education to find the right team.
Yeah.
Might not be educated to know what the right asset looks like. But what also happens is they do that, but they're not built for the ups and the downs.
Right.
And when a down happens, they make a knee-jerk reaction
Right.
and they're out of the game. And if that happens, the whole plan is a wash, right?
Yeah.
So that's why we spend so much time, and I get so excited about things that will help our investors, our JWB investors or rental property investors come up with ways to have that additional $10,000 or $15,000 as a reserve account. Because what that's going to do, it's going to ensure that you stay in the game for a full market cycle. Because those of us in the community here who own rental properties and have been around for a full market cycle, every single one of us can tell you that it works,
Yes.
right? Every single one can, right, Tanisha?
Yes, and I have to I got excited because when you were talking, because we see people that come to us all the time and we're like, oh, okay, and if you can also buy rental properties, and we start showing them like the possibilities, and if you did this could speed this up, and they're like, oh, no, I don't want rentals, and we're like, oh, okay, that's fine, but why? And then they tell us it's because I had a bad experience. I found this property, I fixed it up, it was a nightmare. I put a tenant in there. I was doing the property management. I did this, that. It's crazy. I'm going, okay, I see why you don't like real estate, how you did it. I was like, oh my gosh, what if you didn't have to deal with any of that? What if you had a plan? Like, don't you think that if you had a coach, you knew what you were looking for, you had a strategy and a plan laid out for exactly what it was that you could buy, if you didn't have to find the tenants, if you didn't have to do the management, if you had cash flow, if all of that was set up, don't you think you would have had a better experience? Would you be open if it's that kind of thing? And we don't sell. And just so for your audience, so they understand, I'm sure maybe they already know this, but we don't sell any kind of investment products, right? We work synergistically with JWB and other companies, like I said, that create the fast burning fuel and stuff like that. So we're not, we work together. So when we're telling people, hey, this is an option, we're very investment agnostic, right? We don't care what they invest in as long as it works and it meets their criteria and it's not going to, you know what I mean, blow up their portfolio. So that's what we're teaching them how to do. And people they're like, wow, I wish I had found you 10 years ago or 20 years ago.
Yeah, and speaking of all that, I think I forgot to say at the beginning of the show, we're not financial advisors. This is informational purposes. Do your due diligence, right? Like get on the phone call and, we can help you figure this type of stuff out. But, different investments have different risks and you got to do your own diligence. We're not financial advisors. That being said, we can do this conversation.
Yeah, you both said that very well,
Yeah,
right?
yeah.
We are in love with financial strategies that work. Please do your own due diligence.
Yeah.
But Tanisha, I love your example here when you talk to people who tell you why real estate doesn't work, you hear, or in rental property specifically, you hear that. Oh, well, I don't want to be a slumlord. Oh, I don't want to get late night phone calls. And it's all from this lens of that the only way to do it is to do it yourself. But those same folks are then investing in traditional assets and they buy shares of stock. And if I was to go to one of those folks and say, hey, listen, to run that company, you're going to have to do everything. You can invest in McDonald's stock. You're going to need to make sure that you're serving the customer on the front end. You're going to need to make sure you're flipping the burgers. You need to make sure you're cleaning the stuff. I mean, do you think that they would also say, hey, you know what? I'm not investing in that, right? Of course not, right? Well, but for some reason, I guess because we all live in a house, we think that we are the best to administer the investment in rental properties. And that's just not the case, right? You can enjoy this beautiful asset class and hire a team of professionals to handle it for you, which is in essence what you do when you invest in a share of stock, but nobody seems to make that connection.
Yeah, no, we've never, and I don't believe we ever will, manage our own properties or lease them. We've always hired people to do that. And I mean, that's what makes it passive, right? It's not passive if you're doing it yourself, you know? And so, and the thing is, we do teach people how to invest for themselves, but you're investing in passive assets. So once those assets start performing for you, you're pretty much hands off. That's the key. That's the objective anyway. And so then that gives you the freedom to be able to do a lot of different things. I don't know if you guys are getting a lot of I'm not sure exactly the age range, but I know I have a couple of Gen Z kids. Okay. And I have a 20-year-old and a 17-year-old. And they're really worried about like the job market and all this other kind of stuff because, AI is taking the jobs and it's hard to get entry level and there's all these. And so I'm like, what I'm telling my girls right now is I'm like, look, yeah, that's definitely happening, right? We see that in these huge, companies, especially in Silicon Valley. I mean, that's where I'm from, by the way. I'm from Silicon Valley. So they're just like chopping, they're like, okay, we're gonna get rid of all these people. And so they're like, oh, mama, they're gonna be in jobs. I'm like, there will be new jobs that no one's even heard of, right? So there will be some that are created out of thin air because of this. But if you start now, imagine, right? My daughter's 20. I'm like, if you start now, and she's starting now, investing right now, it won't even matter what the job market is by the time you're ready for it when you're out of college. You won't even, my other daughter that's going to start college next year, I'm like, start investing right now. That's something AI can't take from you. It can't take your rentals. It can't take your investments, right? If it can affect your job, but it can't, you know what I mean? And that's why you need to have these alternative streams of income, and that's another thing we were just talking about, the stock market. Nothing against the stock market. For those who love it, more power to you. But I'm just saying, if you were to, stock all this money away. We had a client that did this. She was in her 30s. She started dollar cost averaging for 30 years every single month without fail. I think it was like $300 or $400 a month she put away. And she was 67 when she came to us. She had 200 something thousand dollars. That's all she had.
Yeah.
200 something $1,000. I don't know how long you guys can live on that. What,
Yeah.
maybe a year or 2 years,
Right.
Maybe the average person could live 5. I don't know. But
Yeah.
she's 7. She was able to be mortgage free, debt free, and completely financially free in less than 3 with us. And she's just, traveling and doing all that kind of stuff. But my point is that you have to kind of see the writing on the wall. You need to have income now and in the future, not just hoping that in 30 years my IRA or my 401k has enough, stocks and mutual funds and stuff like that, that hopefully if nothing's going on in the economy at that time, like a 2008 or something like that, hopefully that money's there, right? You want to create income right now. That's why you're here. That's why you listen to JWB, right? That's why your community is the way they are. They're smart. You want income now and you want it in the future. You want it to grow. You want that growth and you want more in the future. And that's what we're talking about. It's a big difference.
Yeah, yeah. You said a couple things there that really pinged for me, right? Like I'm right now an investor and very involved in one of these like AI companies that's really leading the charge in Silicon Valley of like the agentic future and stuff like that. And I spend a lot of time talking about this idea that during times of massive disruption, there's also massive wealth creation. So that opportunity is there, right? But at the same time, I also spend a lot of time. This is like an AI software that's for property management companies. I also spend a lot of time telling property managers, build your own real estate portfolio. Don't just like expect to sell your property management company because at the end of the day, if everything is changing, how we guarantee our income streams, how we diversify from like the world as it has always been when we know that the future is going to be different than the past is very, very important right now. And I feel like it's a timely topic to figure out how we accelerate these, how we diversify from whatever our W-2 is, whatever our traditional way of investing has been, and figure out other income streams and also and how we, like increase these revenue streams that we can create when we know that things are going to change. Like it might be a wonderful utopia. It might be the Terminator future, but what can give you options is, not being beholden to like one way of doing it when we know things are rapidly changing underneath us. I love the message.
I'll echo both of your
Yeah.
statements. I think this message of like your financial outcomes being based on decisions to generate income,
Yes.
not necessarily net worth income, is so critical in the time and place that we're living in. It's interesting because everybody is on a little bit of edge thinking about AI taking away our jobs, taking away our jobs. But why do we have jobs? We have jobs to get income,
Yeah.
right? Like, if you built up your income
Yeah.
and then AI did take your job away, I'm not saying it's going to,
Mhm.
but you would have accomplished the goal even in the worst case scenario of AI taking your job away. That's right. Whatever is going to shed the light on income is where we need to go. And I think the biggest thing is, I also agree that there are going to be jobs that are created that we've never heard of and all that good stuff. I tend to have a more measured view of kind of like where this impact's going to be. But what I know is even in today's society,
Yeah.
people take a job for money. They take a job
Yeah.
for income. And what I think we have the power to do through rental property investing and through the wealth creation strategies that we're talking about here today, I think you have the ability to have your family be able to follow their passion,
Yeah.
right? What if they had half of their income created by rental property investments, and then they got to go and follow their passion about their life's work rather than working for a dollar? Like, how much better would our communities be, our families, our world, right? Like, that's the real opportunity that we have. It really has nothing to do with AI,
100%. 100%. It's really just about, being prepared and figuring out how to achieve that lifestyle and protect yourself, protect your future. I know I don't, I'm not, I actually love AI. I think it's amazing. So we use it a lot, and we teach our clients that we have a lot of tools that we teach them how to use so that they can do things a lot faster than how they were doing them before. But like I said, that's the whole thing, the risk assessment, the criteria, due diligence, all that. We have all these tools that they can use to do all those things for all the investments any investment they choose. But it's really, I think the safety net and everything that you do really should be based on that whole premise. That's why your community is into real estate investing in the first place, because yes, there are those 5 growth centers. Yes, you will have growth in addition to cash flow. When you add that up though, and you're able to start building out the portfolio and start building out those income streams, that's what's really going to be your safety net in the event that something does happen in the future, and allow you to just live the life that you want to live. I mean, my daughter was saying, they said follow your passions and all that. I think that's bad advice, Mom. I think that's bad advice. And I was like, well, I that's what I did. I followed my passion, but I was able to do that because law was not my passion. Okay.
I was curious.
It was not my passion. I thought it was going to be so much different than it actually is. So in case, people who are listening are thinking about the practice of law, these law shows that you watch, Suits and all that kind of stuff. That's not real. Okay. Not real.
I
That's
didn't see a
not how
single
it
person in
actually
suits reporting a billable hour, just for the record, right?
It's not real. That's not what it's like. So I was actually miserable. I did think it was more like what you see on TV, and I had a rude awakening. Um, but what I told her was I said, I get to do what I want now. And I've been doing it for 20 years. And that's because my assets, my income producing assets covered all of my living expenses, and I didn't have to worry about it. Even if business wasn't good, it didn't matter, right?
Mhm.
Because my bills are paid through my investments. That's the thing. So, that's what people need to understand. That's the way to go to me. Yeah.
Yeah, that's it right there. That's the origin of your story. It's my why. Remember when I came on board, my why was exactly this, right? It was
100%.
like this idea of I don't want to be reliant on, the things I have to do as much as the things I want to do. And it's really interesting how when we talk about the bright future of AI, is this utopia where everybody gets to go pursue whatever they want? But that bright future is here for real estate investors like you guys.
Right.
Like,
Yeah.
so we don't need AI for that, right? Like you can just be really intelligent about how you financial engineer this. And I think that's a really good kind of like exclamation point on this conversation. Tanisha, we got a couple questions here from the man we call the patron Santorius of our community, Michael Santorios. He's asking, many of us on this show have done private money lending secured by a registered mortgage. How are these loans secured? What is the minimum amount invested when you're talking about the fast burning fuel stuff?
Yeah, so a lot of it's not even loans, but I used Prosper as an example. So those are loans, right? And those are unsecured. But what they do is, you can decide when you're investing in those, your risk tolerance, right? So they'll go anywhere from say 7% up to say 20%. So obviously, actually it's a little bit different if once you know and you understand the asset class and you've done your research and everything. But I'll give you a quick little tidbit. Usually or historically on the low end and the high end is where most of the defaults occur. So you want to stay somewhere in the middle. And really that also depends on your risk tolerance and things like that. But so those are unsecured, but what they do is if someone does have, say, really good credit, so their interest rate's going to be a lot lower, and you're basically investing in those individuals, you're loaning money to them, they actually go after them as far as the credit reporting. So they'll go after them, they'll be put in collections, all that kind of stuff. There's no actual security for that type of loan. So again, depending on your risk tolerance, depending on your criteria, that may or may not be the right fast burning fuel for you. If you're looking for it being backed by something else, that may not be, then that's not it for you. Maybe you want to do something else. So other types, like I said, some of the ones that are created by the financial firms that have come to us. Another one is ground floor. Okay, ground floor is a little bit different. That one they back it up, right? They're more of a startup though, so they're newer, right? Prosper's been around, I think, for 15 years or longer. But they're newer, so there's some risk there. So you always want to know, where are the risks in all the investments that I choose? What is my criteria? What's my risk tolerance? And then that'll narrow down your scope, right? You don't have to look at these other investments because they don't fit what you're looking for. Look at these over here. And so yeah, so you can and guaranteed you're gonna run into, especially if you're part of our community, you're gonna run into people who are investing in a bunch of different things, and some things are good and some things are not so good, right? So you want to be able to identify how good they are. If they fit your criteria, do your due diligence. Will help you with that, whether it's like I said, your crazy cousin Larry or someone else who has a great investment opportunity that they've heard of, that is backed by real estate or backed by some other asset class or whatever. There's still risk to that as well. So, but you just need to know what those risks are and be prepared for that. Yeah.
And Michael was also asking kind of what are the typical like terms for these types of loans? Do they vary wildly, or is there like a kind of like a boilerplate of like how long or how short you like to go for in these short term kind of fast burning fuel scenarios?
Yeah, no, it varies, right? So they can range from 2 years to 5 years typically. And there's some that are a little bit longer, 7 years. but 2 to 5 years, it could be 2 years, 3 years, all the way up to 5 years is the norm. And then it just depends. Some of them aren't, we're saying loans, but they're not always loans. Some of them are funds, right? So again, you're not necessarily loaning money out. What you're doing is you're getting principal and interest back from your investment. So it's like a loan. So they're not always loans. In addition to that, there are big financial firms that you can do this yourself. There's a way to synthetically amortize certain investments that do produce income as well. So not all firms, but some you can do that. And so we'll show you how to do that too, and which types of investments you can do that for. So it really is a matter of, do you like the stock market? Do you not like the stock market? Regardless, you would want income, right? So you have to have income with fast burning fuel assets in order for it to work. And it's got to be, usually principal and interest, which makes the payment so much larger than if you were only getting interest. Now think about it, going kind of back to the beginning, we talked about the cash flow arbitrage, right? Cash flow arbitrage would not work if you had an interest only line of credit you were using and you were getting an interest only investment. Like it's basically going to cancel each other out. Like you would maybe, if you had a line of credit that had a 5% interest rate and you had a investment that was paying you 7%, you'd maybe make 2%. That doesn't even make sense. Why would you do that? It's a waste of time, waste of energy. Use your money in the right way. So the cash flow arbitrage is really the key to making it work. But I'm so glad you're asking that question, because most people don't ask, right? They're like, oh yeah, whatever. And they just want to invest in anything. And that's the surefire way to screw this up. So yes, you can screw it up if you just invest in anything. You don't have a plan, you don't have a strategy. You should know before you invest if it's going to work for you and whether it fits all the criteria and checks all the boxes. Checks all the boxes, go for it.
Makes a lot of sense. I was just showing the appointment to schedule with Tardis. I'm seeing people in the chat. I see HT booked a consultation. Seeing a lot of really good conversations here. One last question here from Linda Mercurio, who I think on the last webinar booked a call with y'all. She's saying, I had tried to do an analysis for 3 years based on having $1,000 of cash flow use with Tardis, and it showed me that cash flow increases, but most of it was from the cash I was contributing, considerably offset by expenses. Future years could show that growth of cash without requiring contributions. In this scenario of 1K a month, is that the way it should work, or that you need to get through the first few years first? That was a long read there.
Yeah. Okay. Okay. That is a long question. Let me see if I can answer it. So, so it depends, right? So we have clients, like I say, some of them come, it's not a lot, but we do have some that are like, oh, I only have $500 and we'll help them find more cash. Initially, it's the cash flow that you start with that's going to help power this thing. And then you're going to use that small incremental leverage that's going to give you more buying power. What that does is that enables you to get more cash from that investment quicker. And then it also depends on the term, right? The term and some other things with the actual investment that you're using. So depending on the investment you use and the interest rate on that investment and the term of that investment, you can actually speed it up and you'll have more cash flow coming in from the investment that'll overtake it quicker, right? Some people, it'll take them to year 3 before they see, ooh, the cash flow that's coming from my investments is way more than the money I'm putting in. But for some people, it takes 3 years. And the reason for that is because they're using a smaller interest rate investment. And that's what you should do if that's your risk tolerance, right? So maybe they're using a smaller interest rate investment. Maybe the term on the investment's longer. Maybe it's 5 years or 3 years instead of 2, for example. So there's a lot of factors that play into how soon you'll see more money coming in than what you're putting in. And then, by the way, when you reach that financial freedom date, you stop putting money in. There's no money from you, right? So that could happen as quickly as 2 years, 5 years, 6 years, 10 years. So you're not putting any more money in, you're just taking money out. And you can stop working, you can travel the world, you can do whatever you want to do if, financial freedom is your goal. If your goal is, hey, I want to buy my dream home, or I want to do something else, I want to buy a Ferrari, whatever, you can do that too. You know what I mean? If that floats your boat, you can do that too, right? I'm not so much into materialistic things. I'm more into spending time with family and friends and traveling and going to the Olympics and stuff like that. So that's what I spend my time doing. But you know, to each his own, and you can do it all. So it's awesome.
Like that. We hit exactly an hour with all the questions. This has been amazing, Tanisha. Really, thank you for, sharing all this stuff with us. I'm super curious. I know the community is really curious. I know folks from your community are here, and they're curious about JWB. I can see why this fits so well. So I just want to welcome anybody. If you want to schedule an appointment with JWB to set up that slow burning fuel, those like buy and hold rental properties without the headache in one of the best markets in the United States here in Jacksonville, go to chatwithjwb.com. If you want to create your income snowball, schedule an appointment with Tardis by scanning this QR code and joining their community. But I want to thank our community, right? We had around like 80 people in here today. Amazing feedback in the chat from the knowledge that was being dropped. But more than anything, I think the value of the chat is everybody talking with each other. Like, we love the fact that you take an hour out of your day to come here and learn about innovative ways to become financially independent, to chase your passions. And I want to applaud you for doing that. And do you see anything that you'd like to add?
Tanisha, thank you so much for being here. And I just want to echo that. Whenever we get to have a financial conversation, it just lights me up, right? Because we connect the financial conversation with how it's going to impact your life, right? And Tanisha, I know I could see your eyes light up when we were talking about those things as well. It's so nice to have you on our platform, get you introduced to the Not Your Average Investor community. And our group is just incredible. Thank you so much for making it so warm and inviting for Tanisha to be here. We love you guys. And we appreciate you so much.
Tanisha, anything that you want to call to action or anything you want to tell folks before we get out of here?
No, I think just, get your education now, like learn now, start now, don't wait. There's really, time is ticking, things are happening, the world is changing, and now's the time. So I would say, if you're so inclined, just find out. It's just information, book a strategy session, find out if it will work for you. You'll know from that, you have a whole plan laid out with a timeline. And so you can't beat that. You know what I mean? Gives you clarity. Yeah.
Rave reviews coming from the chat all the way around. Next week, we are talking about the underrated signal of future home price appreciation. This is some real nerdy data, insider real estate info that we're going to be talking about. But from here till Tuesday, we hope to see you there. But we got one little piece of advice we'd like to leave you with. Don't be